What if I told you there's a completely legal way to cut your tax bill by 10, 20, $50,000 or more every single year? And most people with sudden wealth either don't know about it or are doing it wrong. In this video, I'm going to reveal three things. Number one, what tax loss harvesting actually is and why most people mess it up. Number two, how this strategy can quite literally save you tens of thousands in taxes with real numbers and hundreds of thousands in compound annual growth effect on your wealth. And then number three, a simple step-by-step process you can use this year to protect your wealth. Hi, my name is Tommy Cloud. I am president of Third Act Retirement Planning. It's a company that I started back in 2000. I'm also a certified financial planner and qualified kingdom advisor. We believe money should bring clarity and peace, not confusion and fear. Our why is to walk with people who've suddenly come into wealth, helping them move from overwhelm to confidence so they can make calm, informed decisions about and legacy. What is tax loss harvesting? Here's the big idea. When you have investments that have dropped in value, you can sell them at a loss to offset gains from winning investments. This reduces your overall tax bill and allows your account to keep growing with more money annually in a compound fashion. And in time, it results in a big difference in the value of your portfolio. And this is particularly important to accounts that are taxable and are large. The more money you have in a taxable account, the more important this video is to you. Let me give you an example. Let's say that you made $50,000 in profits from selling some stocks, some winning stocks this year. Normally you pay taxes on the entire $50,000. But if you also sell some losing investments for a $30,000 loss, now you only pay taxes on a $20,000 gain instead of the full $50,000 gain. And that's another important reason for diversification. If you have diversification in your taxable account, whether it be through stock sectors, for example, technology, energy, consumer staples, utilities, financial, or you have true asset class diversification, gold, Bitcoin, stocks, bonds, utility stocks, and then maybe some managed futures funds or even some hedge fund strategies that are mutual funds. These are not correlated. So when the winners are winning, you can use maybe some losses in your portfolio to offset the wins and literally keep those taxes. They can be reduced sometimes down to zero year after year. So your money can be growing in a taxable account with you paying little to no taxes. Now, you will pay taxes on the side of the money that's inside of an ETF or a mutual fund if you use those. But if you use individual stocks and buy and sell those each year with the tax loss harvesting, you literally can reduce your taxes in some cases down to $0 per year if you have an effective tax loss harvesting strategy with stocks alone. So why do most people get this wrong? The biggest mistake? People think they have to get rid of good investments forever. That's not true. Here's the smart way. Sell a losing investment, capture the tax loss, then buy back a very similar investment after 31 days. The IRS does have a wash sale rule. If you buy back the exact same thing within 30 days, you can't claim the loss. But a similar investment, that's totally fine. So if you have stocks, and let's say this particular year that financial stocks are down, and let's say technology stocks are up in this particular year, you could maybe sell some of those technology stocks, and that's going to create gains, but you could also sell some of your financial stocks. That's going to create realized losses, and the losses will offset the gains. And then what you can do is you can go back in. You don't even have to wait 31 days. You could immediately buy a different technology stock and immediately buy a different financial sector stock, and your portfolio is still very similar. You still have exposure to technology, you still have exposure to financial, but you've been able to realize the gains in your portfolio and have those gains offset by some of the losses for that particular year. So let's say that you own a total stock market index fund that's down. You can sell it, claim the loss, and then buy a different total stock market fund. You stay invested, but you keep the tax savings. So here's the step-by-step action plan. Here's exactly what you do. You look at your taxable investment accounts, not your 401k or IRA. Those are tax deferred. Only taxable accounts count. Step 2, identify investments currently worth less than what you paid. Your brokerage statement will show these as unrealized losses. You just go to the tab on your online and you'll see this. And then step 3, calculate your total gains for the year from other investments or sales. Again, this will be on your unrealized gains loss tab inside of your account online. Step 4, sell enough losing investments to offset those gains, plus up to $3,000 against your regular income. So in other words, you can create an additional $3,000 of losses, and that can be used to reduce your income, which is different than the capital gains or short-term gains on the stocks that you have inside of your portfolio. Step 5, wait 31 days, then buy back similar investments if you want to keep your portfolio on track. And I would encourage you, if you are buying back in, to really examine the rules with your accountant about, say, for example, if you sold, say, a Vanguard ETF to go right back in and buy a Schwab ETF, for example, or a DFA ETF, then you don't have to wait at all. But you want to make sure you get clarification on that with your accountant. So I don't want to give any tax advice here. Number 4, as we're moving on here, let me just give you a kind of a story. A client inherited $800,000 and invested it right before a market downturn. Her portfolio dropped to $720,000, which is an $80,000 loss. Instead of waiting for it to recover, we harvested those losses. She saved about $30,000 in taxes that year by offsetting her gains, but she still had an extra $50,000 in losses to use in future years, which gave her a tremendous amount of flexibility on the withdrawals from this account. In future years, with that $50,000 loss, she didn't have to worry about, oh, what are my taxes going to be when I make this withdrawal, because she was carrying forward that $50,000 loss. When the market bounced back, she was in the same investments, but she kept that $30,000 that would have gone to the IRS. Here are some common mistakes to avoid. Waiting until December. Markets move all year. Check your portfolio every quarter for opportunities. Check your portfolio in January, April, July, and October, for example. Harvesting in retirement accounts, own tax accounts, taxable accounts benefit from this strategy. Keep that in mind. Another mistake, violating the wash sale rule. Don't buy the same investment within 30 days before or after selling. Be very careful with that. And then not harvesting enough. If you have $100,000 in losses and only $10,000 in gains, harvest more and carry the extra forward. Future you will thank you. Trust me, you're still going to be in the market. I'm not saying we're timing the market. I hope you're not hearing that. Realize the losses, and then you can just jump right back into the same market that you were in before. Trying to get the camera adjusted there. If you've recently come into sudden wealth, you're going to face tax challenges most people never see. Tax loss harvesting is a powerful tool to keep more of your money working for you. Click on the link to schedule a free sudden wealth planning session with me, and we can talk about how tax loss harvesting could benefit your taxable accounts and your portfolio. Don't let taxes eat away at the wealth that has been placed into your care. Be a good steward. Be a great steward. Seek wisdom. Start harvesting those losses, and I'll see you in the next video.